Welcome to Alternative Investing. I'm Andrew Bell. Here with me, my regular Friday co-host, David Kaufman, president of Westcourt Capital. Great to see you.
Good to be here as always.
How crazy is this? I mean, the Arab world looking more and more like a powder keg. I mean, do you get a sense of fear or what's going on here?
We've seen, of course, volatility over the last few years going crazy.
Yeah.
And, of course, this is doing nothing other than exacerbating that. And the sense of fear, you see the volatility across markets, across the globe. And it's, if nothing else, it's certainly a good reason for people to consider alternative investments more than ever.
I knew it would come to no, but I was thinking about that. Yeah, but you know, $1,400 gold, and you just don't know what country is next.
That's right.
Anyway, yep. So David gave you the pitch, one of the attractions there for alternative investing. When the stock markets wobble, generally these asset classes are intended to stay more stable. On this show, of course, we explore investment concepts that are outside of the traditional realm of stocks and bonds. For investors like you who may be looking to expand your portfolios with alternative places to put your money, places not in the public markets, but in funds or products that fly a little more under the radar. On today's show, we are talking about a hot aspect of the commodities market right now. We've got prices for corn and wheat soaring, so more investors are paying close attention to the potential profits in farmland. And today, we're talking about all the different ways alternative investors can get in on investing in Canadian farmland. For this, we have two special guests. In Calgary, Stephen Johnston, partner with AgCapita Partners. Stephen, thanks so much for joining us. I didn't hear Stephen there, but maybe we're okay on the sound. I'll check that. And in studio with us, we've got Tom Eisenhower, President, Bonifield Financial. It's great to have you here, Tom.
Thank you very much. It's good to be here.
Tom, can I start with you?
Certainly.
Tell us a bit about yourself and tell us a bit about Bonifield.
Sure. Bonifield is a relatively new firm, as we founded Bonifield as a farmland investment manager back in 2009. My personal background is a long time, 25 years on Bay Street, originally in investment banking. Then came to this, most of my time was spent in technology investment banking, and from there started and ran for 10 years a technology private equity fund. So I came to this really from the point of view of looking for assets, having come from that technology, the volatile world of private technology investing, looking for assets which would have, you know, lower volatility, be steadier performers, more predictable performers. Given the way that the world has gone post-2008, it's certainly the way that I personally wanted to move, and my partners as well, and we founded Bonifield to do just that.
You've been around for a while. You were involved in RIM's IPO?
A while ago, yes. It was RIM and JDS and quite a number of them.
Oh, my goodness.
That's right.
Stephen, can we turn to you? AgCapita, you've had some heavy-duty people involved with you, I see, including Jim Rogers has been on your board or advising you. Kenneth Clark, former very heavy hitter in Maggie Thatcher's government. So you've got some big names behind you.
Yeah, I mean, I think it speaks to the real fundamental appeal, certainly for macro-oriented investors of the asset class. You know, as Tom rightly mentioned, there's a lot of interest in obtaining exposure to agricultural commodity returns, but in a way that doesn't have a lot of volatility. And of course, farmland fits the bill perfectly.
And what does AgCapita do? Could you summarize? What investors do you deal with, etc.?
We have focused on creating a retail offering. So we have the only RSP-eligible farmland fund in Canada. Our funds don't use leverage, and our geographic focus is purely Western Canadian prairie farmland.
I have a question for both of you. I'll start with you, Stephen. Both of you actually have a long history of working across really the world, across also different asset classes in the economy. And what I'm wondering is how it is that you came to be an opportunistic investor, and how that led you to focus on farmland specifically.
Yeah, I mean, my background was before I came back to Canada to start an asset management business. I was the head of an emerging market private equity team for Société Générale. We managed about $500 million, and our focus was the former Soviet Union. And really, when you're an emerging market investor, emerging market returns tend to be very cyclical, and of course, macroeconomic fundamentals have a very significant effect on the outcome. And so you really have to be careful about picking your entry points. And by that I mean you have to know that you're getting a margin of safety, which is a really straightforward concept. are you acquiring assets or cash flow inexpensively? And so that experience has really flavored my entire approach to investing, and certainly farmland as an investment really fits within that framework in my view.
Now, actually, before we go on, David, full disclosure, you and Stephen, you're working with AgCapita right
That's right.
now.
Our firm is in the midst of procuring financing for them, just for full disclosure.
Helping them to raise money.
That's right.
You've no dealings with Tom, though?
None at all. He's my good friend.
Much to his chagrin.
Tom, I mean, anything to add to what Stephen just said about investing
I
in
would
farmland?
echo very much what Stephen had to say. Looking back on the sort of the last 10 or 15 years of our involvement, particularly with technology private equity investing, when we look back as a firm and we said, we were fortunate to have made some money in that and had some good returns, but when we looked ourselves really hard in the mirror, it was hard to say that the returns we made justified the risks that we took in retrospect because of all of these macro factors. I mean, you just look at the stock market in general over the last 3 or 4 years, but technology in particular. Surely there had to be a lower volatility, steadier, eddier kind of performer. And that really led to a search to farmland, which has been an asset class, as you know, very popular with high net worth and institutional investors around the globe for generations. But just not so much in Canada. So it's emerging in Canada.
That's interesting. One of the things that we've learned on this show in recent weeks as we speak to opportunistic investors is that they have experience around the globe across different asset classes, and they talk about a top-down approach to say where's the next big thing, so to speak.
Sure.
And then they go and they deploy assets and expertise in that area. And then you, of course, have to have a bottom-up approach to determine which specific securities in that class to buy. And that's very, very important that, from what I understand, neither of you set out 20 years ago to say, I'm going to have this career so that I can end up investing in farmland. It's more that's what is not so much the investment du jour, but the investment maybe of the next decade.
Yeah, absolutely. It's your point's well taken. I would never have thought 20 years ago that I would be investing in farmland, but rather it was the attractions of the asset class that. There.
We got to take a break. Tom and Stephen are staying with us, as of course are David and I. Coming up, we've got the full half hour today with both of our special guests. We're talking about investing in farmland. Everything you need to know about making money from investing in one of Canada's richest resources. We'll be back right after this. Welcome back to Alternative Investing. I'm here with David Kaufman of Westcourt Capital. Today we are talking about investing in Canadian farmland. It's great to have you here as usual, David. With us are two expert investors in farmland. In Calgary, Stephen Johnston, a partner with AgCapita Partners. And in studio with us, Tom Eisenhower, President, Bonafield Financial. First off, David, full disclosure, you currently have a relationship with AgCapita.
That's right. We're raising capital for a current raise for them and working closely with them in that regard.
Stephen, could I turn to you? Where do you buy farmland with AgCapita, and how do investors actually get money back out of the security?
Yeah, I mean, we have a model actually which is focused on acquiring the lowest cost price of production, basically. Because when you're purchasing farmland, really the absolute price per acre is not really the most relevant point. What's the most relevant point is the price of the production you're buying. And so we filter all of our potential acquisitions through a model which prices out the bushel of productivity and then superimposes on top of that the historical volatility of that yield. And so what you're getting is, hopefully, the lowest price bushel of yield with the lowest historical volatility. And when we run those numbers, and when you look across Canada, when you do that analysis, you invariably circle back to Saskatchewan because you can get very low, unvolatile historical yield with very discounted cost of production. And if I can just make a comparison, a bushel of production in Saskatchewan might be $16. That same bushel of production might be $30 in Alberta, and that same bushel of production somewhere else in the world in the developed markets and even sometimes in the emerging markets might be on the order of $40. And so it's as if you can buy IBM stock in Saskatchewan for 4 times earnings, 10 times earnings in Alberta, and 15 times earnings in Brazil.
Now,
of course you would buy in Saskatchewan.
Now, of course, before we start to hit the map directly on Saskatchewan or Western Canada, the first thing that any investor would want to assess would be the macro thesis regarding why invest in farmland in the first place. And so I know that we have a board here that talks about the basics of food, feed, fuel, and inflation, which is the concept of driving up, in a macro sense, driving up the value of farmland across the globe before you get specific in terms of where to buy it specifically. Can you talk to us about that, food, feed, and fuel?
When we started our fund 4 years ago, it's actually it's slightly amusing. The vast majority of our presentations were on the macro drivers, the food, feed, and fuel, because those demand factors are actually very well understood. There was a limited amount of material on inflation, and I guess in those intervening 4 years, we would have never expected the kind of money supply expansions that we've been witnessing, and certainly with the expectation of future inflation that creates, inflation has become a much more important driver and why investors are looking at farmland, because, of course, farmland has excellent inflation hedging characteristics.
Now, Tom, we know that this macro thesis has led to an enormous amount of institutional investing in farmland across the globe. So we hear about Africa, we hear about Russia, the Ukraine, Brazil. We don't hear as much about Canada. Can you talk a little bit about the kind of risks that are being assumed by those institutional investors in those areas of the world?
Well, one of the reasons that we, taking your top-down approach that you spoke of earlier, we kind of arrived at Canada as on a risk-return basis, offering the most attractive return, touching on factors such as political stability and access to water, which is a very important consideration for farmland. Location, the productivity of the soil, climate change is a huge factor going forward. Canada, of course, is going to be affected by climate change, but compared to many of the other key farming regions of the world, the impacts here will be much more benign. So when we're looking at it on sort of a global basis, as you referred to, it's pretty hard to come to any other conclusion that Canadian farmland is a pretty attractive risk return.
Now, you and David, you're not working together. You have no business relationship, but you don't sell retail. You sell to institutions more.
Our focus to date has been exclusively high net worth family offices and institutions. We don't have a retail offering at this point.
Well, when we talk about Russia, Africa, Brazil, we can't ignore the concept of political risk in a big way. Stephen, I know that you have a lot of experience having worked in the former Soviet Union with different types of securities. Can you talk about your experience about how that creates any fears in your mind about continued investment in relatively politically unstable geographies?
Yeah, I mean, I think that the mistake a lot of investors make when they look at emerging markets is they price political risk on a continuum. Now, of course, political risk is typically a binary risk. You either are expropriated or you're not. And so I think that people tend to be undercompensated for political risk when they make these investments. And just by way of example, Brazil has attracted approximately $5 billion of foreign direct investment into agriculture in the last 6 or 7 years. Just in the last year, the government has actually started to implement legislation which effectively bars foreigners from investing in farmland, and then there is discussion to extend that legislation retroactively, which is effectively an expropriation. So Brazil, which was one of the most active markets for farmland and agricultural investment, is giving a very graphic demonstration of the kind of risk you take in the emerging markets, particularly in a very politically sensitive area like agriculture and food supply. And so our view is that political risk will be a key determinant in farmland returns. And so if you can get farmland returns in a low political risk environment, I think that you're well set.
We're going to touch on that controversy in a moment. It's really good that you brought it up, though, the political factors here. Tom, could I just ask you, though, Saskatchewan farmland trades at a pretty major discount. Could you talk about why that is?
Well, one of the major reasons is that historically Saskatchewan and Manitoba have had fairly restrictive provisions on who can and can't own farmland. As it stands today, you effectively need to be a Canadian citizen, an individual Canadian citizen. So if you're a publicly traded corporation, if you are an institution that has beneficiaries that may not be Canadian, that is not permitted. You can't today hold title to farmland in Saskatchewan, which has had a predictable impact on the prices in Saskatchewan.
I think we have a board that shows how cheap farmland is in Saskatchewan. Stephen, that makes it a bargain, I guess, by your lights.
Actually, I think that that chart understates the discount that you're getting, because when you normalize across all these markets and you derive the price per bushel of productivity, Saskatchewan, and that's then you can make a like-on-like comparison.
Unbelievable how cheap it is.
Saskatchewan's trading at a 60% discount to most markets.
Yeah, and in Britain, we've got a chart up. Farmland costs $10,000 an acre, whereas in Saskatchewan it's less than $500.
Those are averages.
Yeah,
I could take you and show you farmland in Saskatchewan that trades at $1,500 an acre.
Sure.
And, it really relates, farmland, like any other form of real estate, it's location, location, location. and you layer on top of that the productive qualities of the soil within any province, Saskatchewan, Ontario, where have you, it really depends on access to water, on the productive quality of the soil, what can be grown there. It's, all farmland is not created equal.
That's a very important point, because what you're essentially saying is that, notwithstanding the fact that the commodities that are produced on these farms are relatively non-perishable and very portable, that the actual land that's used to produce those commodities is not itself a commodity, in the sense that 2 acres are not necessarily alike.
Which is true, the strategy that Stephen and AgCapita are pursuing, I think, is an absolutely correct one. That there is an arbitrage, a big one, as your board just showed, between Saskatchewan prices and the rest of Canada and the rest of the world. Our approach is that slightly different in that we believe, looking forward over 20 years, agriculture is a great place to be for all of these worldwide trends that we're talking about. We believe that farmland, particularly Canadian farmland, is the lowest risk, steadiest, lowest volatility way of playing that. And so our goal is to assemble a portfolio of farmlands across the country.
Okay, I'd like to address with both of you. Sure. Let's let the rubber hit the road. How do you actually buy the farmland? So how do you choose which farmland is appropriate to buy? And then do you hop in your car and go buy it? How does that transaction actually take place?
Right. Well, again,
in our case...
Go ahead, Steve.
Sorry, go ahead, Tom.
In our case, it's we sit down, we look for areas that appear to be, relative to the productive capacity of the land appears to be trading at an attractive value. So that's step one. Step two, then, is to go and sit down with the farmers and meet some of the more progressive farmers that, in our case, we want to form very long-term relationships with, and work with them to do sale leasebacks, to secure land that they're already maybe farming but leasing from someone down the road on a handshake basis, or to provide them with growth capital to grow their farm. So ours is very much a farmer-focused kind of a program.
Stephen, how do you go about acquiring the land, looking at it?
Well, no surprise, there will be a lot of similarities between our two processes. I mean, our focus is similar. As I mentioned, our primary filters initially are the price for a bushel of productivity and then the historical volatility of that productivity. And then, of course, we do the local analysis, which is the distance to infrastructure, local land price trends, the fragmentation of the local market, the ability to build up large blocks of land, which, of course, are more appealing to renters and purchasers. The local rental characteristics, gross rental rates, how active is the local rental market. And so we do a qualitative analysis, which is we go out and look at the land, the topography, we interview potential renters, and then we do a consistent, reproducible quantitative analysis based on those factors that I just mentioned. And so it to a large degree, it will be a very similar process to what Tom's fund does.
Got to take a break. Coming up, our conversation with Stephen Johnston of AgCapita and Tom Eisenhower of Bonafield Financial will continue. But we're going to shift gears. We're going to take advantage of their years of experience in capital markets. We'll get their opinions on issues like quantitative easing and how effective the Fed is in today's world. Stay with us. Welcome back to Alternative Investing. I'm here with David Kaufman of Westcourt Capital. And, of course, in Calgary, you've got Stephen Johnston of AgCapita Partners in studio with us. Tom Eisenhower, President of Bonafield Financial. David, you want to have a go at Ben Bernanke, I believe?
I do. In December, Ben Bernanke had an interview with Scott Pelley on 60 Minutes where he made a couple of comments that sort of had reverberations across the globe. And the exact question, which I think we have here, Scott Pelley asked him, you have what degree of confidence in your ability to control inflation? And without skipping a beat, his answer was 100%.
And you weren't impressed, David?
Well, if you looked at the blogs across the world, I thought that's amazing. So my question to both of you, I'll start with you, Stephen, is the question of, in a flat world, how much ability is there for the Fed to play marionette with the markets? Where are we going with this?
Well, ultimately the Fed's going to be faced with a difficult decision, because at the margin they can control interest rates or exchange rates, and eventually the market's going to demand that they make a definitive choice between the two. They won't get the nice pleasant blend of low interest rates and a gradually falling dollar. I think the time is coming, and it's probably not in the too far distant future, where they're going to be forced to make the choice between low interest rates or sacrificing the dollar. They clearly have indicated that they're going to choose low interest rates. That will have global ramifications for inflation, and of course assets in that environment can, in nominal terms, go up. And there's that old chestnut. that the best performing stock market in the last decade was Zimbabwe. It went up 1 million% in 1 year, but unfortunately, inflation in Zimbabwe was 250 million% in the same year. And so, the Federal Reserve is clearly making the decision that nominal asset prices are the only thing that matter to them.
Tom?
Well, I totally agree. I mean, to echo Stephen's point, they basically have two tools in their kit. One is exchange rates and the effect on the dollar. The other is interest rates. But you don't have to be a genius to figure out that with interest rates as low as they are, his ability to continue to control and use that lever to impact is gone. And that's why you see them leaning to, looking for other tools such as QE1 and QE2 and these other sort of monetary policy tools, which amount to much the same thing, amount to printing money. That it's an indication that their toolkit is getting pretty empty.
Now, something that is outside of Ben Bernanke's control, I believe, is the expanding population of the middle class in China, which, of course, forms part of the macro thesis for farmland.
Farmland in Canada.
But what I'm interested in is what other effects will the expanded middle class in China have in other markets?
Well, what effect won't it have?
There are two very well-established relationships. As you approach sort of $5,000 of GDP per capita, there's a very pronounced increase in your consumption in two commodity complexes, agriculture and energy. And so we've been discussing agriculture, but the other area where the emerging economies at the margin are having a very pronounced effect on prices is in energy, and particularly oil consumption. If you look at China, they consume about 8 million barrels per day, which is about 10% of global production. It's about half of what America does. But when you look at it on a per capita basis, they consume about 3 barrels per person per year. Now, of course, South Korea, which is a country that I think we would all reasonably expect that China could approach a South Korean standard of living, they consume 17 barrels per person per year. So it's an enormous increase. And so I think what you'll see over the next 2 decades is as GDP per capita increases in China in particular, we're going to see very pronounced effects on energy demand. And, of course, that should create real upward pressure on prices.
That's an amazing figure. And look at South Korea. I mean, after the Second World War, that economy devastated. Look what they did in half a century.
Right.
Yeah, guys, thanks so much for joining us.
It's been a pleasure. Thank you.
We want to hear from you at home. Alternative investing at bnn.ca. Thanks to our two guests, Stephen Johnston, a partner with AgCapita Partners in Calgary, and Tom Eisenhower, president of Bonfield Financial, and of course, the one and only David Kaufman. We're out of time on today's show. We'll be back next Friday, 11:30 Eastern, 8:30 Pacific, with another edition of Alternative Investing.